Amit Jyoti Lakar wants to know what will be the impact on debt funds if the stock market crashes?
There won't be much of an impact on the debt market or debt funds if equity market crashes, equity funds or equity market crashes, simply because the dynamics of the debt fund or the on the fixed income market is very different. What actually has a bearing on the fixed income or the debt fund is the general state of the economy and the inflation rates. If inflation goes up, interest rates go up, and that has a bearing on the debt funds. Bonds are badly hit if interest rates go up. Bonds benefit if interest rates go down, and so that's one. The other is if the credit quality improves or deteriorates. If a lot of companies are in difficulty and they are facing problem in terms of poor economic conditions, their poor leads to their poor financial health, and they are unable to honor very well all their debt commitments in terms of repayment of principal and interest on time. That will lead to lowering of credit quality, credit rating, and a default will lead to that part of the money getting affected. So credit quality has a bearing, interest rate has a bearing, and the third thing is the liquidity. Liquidity in the system uh, reduces the charm of money in the short run. So these are the three broad variables. There is one connection between equity and debt market, which is when interest rates are low, it is generally considered to be good for the equity market, simply because when you don't get any meaningful return. So there is a connection between uh, debt market and equity market, that equity becomes attractive because people are willing to take chances. When you get very lower return for not assuming chances, you think that it is worthwhile to take equity risk. Your equity, even if you get little more return than fixed, or marginally higher return than fixed income, that is worthwhile, because otherwise you are squeezed of returns on from your investment. So there is a relationship between equity and debt, but not directly.